Hi everyone, I'm Paul, and in today's video I'm going to be walking through the fair value gap method taught by ICT, or the Inner Circle Trader, in his YouTube mentorship program. Now, for those of you who don't know, ICT's been a trader and a trading educator for about 3 decades, and so if you've been studying trading for any period of time, you've likely come across his teachings before, or you may even be using them in your trading at the moment, even though you may not know. Anyway, so ICT has his own YouTube channel where he's sharing lots of his teachings, and so if you enjoyed this video on the fair value gap method that I'm going to walk through today, I really encourage you to go to his channel. I'll link it in the description and go through his online mentorship course. It's completely free and it's really excellent. Now, in the training, ICT mostly uses the S&P futures and sometimes the NASDAQ futures. I won't be doing that in this video. I'm actually going to be applying the fair value gap method to crypto. I wanted to test for myself if these would work in crypto markets, and the results I've had so far have been really encouraging. And so my plan is to document these and share them on my channel. So I'm pretty much up to date on the mentorship program as it stands. I've gone through some of those lessons a couple of times because there really is just a lot of information in there. ICT has been really generous in sharing his knowledge. I've really enjoyed the program so far, and I'm sure it's going to help a lot of people. So if I've made any mistakes in my interpretation, feel free to leave a comment. ICT, if you're watching, definitely feel free to leave a comment. Now, in this video, I'm going to be going through 2 paper trades on Bitcoin and then a real trade that I did on Ethereum. So let's jump in. So before we jump into the charts in too much more detail, one of the things that ICT covered in one of his recent teachings, I think it was episode 10, was the application of bias. Now, I hadn't done this in some of my paper trading before, and I was getting a little bit confused as to why things weren't working too well. And so in hindsight, there was 2 things that now stand out, is that I wasn't applying bias to that particular day or that day range of trading, and that I hadn't really properly set out my highs and lows. And so that's a really critical thing, is to be trading in the right parts of the range, because if you're not and your bias isn't correct, then your just setups aren't going to work. And so that's a really critical part of the whole setup. So unfortunately, I recorded this all earlier in live, and so the idea was to go through the trades in real time. Unfortunately, there's no audio in that video, so I'm doing it all again. So unfortunately, it won't be in real time, so we're going to have to go through it again. But if I start with the daily chart, so looking at the daily chart, you can see our last 3 candles have all been down days, and pretty much when I'd started this before I had to re-record, the market was up slightly. And so the expectation was still that today would be a down day. So my bias was again bearish. And so one of the things that ICT taught in his most recent video is, if we think about, the day being a candle. And so, you've got your wick here and your wick here, is that, the market will open, and on a bearish candle, what we're going to have is we'll have the open up here, and then we obviously have the high up here. So what we're looking at is that the market will open and then it will rally into that high, and then for the remainder of the session it's going to fall down. And so in terms of finding fair value gaps, what we're trying to do is find the fair value gaps in the wick, or between the top of the wick and the open. And so this is sort of like our target range, if you like. We don't want to be entering fair value gaps down here because we want to maximize the probability of the setup working. So this zone in between the open and the high for a bearish candle is what we're anticipating. So what we're guesstimating is that the market's going to open and in the first part of the session rally up and then sell off for the rest. And so that's pretty much what this candle will be. Open, rally up, fair value gap, we get set, and then the market falls away. And then the opposite would obviously be true for a bullish candle, is that we're going to open down at the bottom here, the market will fall away, set a low, and then we'll want our fair value gap to be forming somewhere between the open and the low. So we'll be, hopefully getting in here somewhere, and then the market rallies throughout the rest of the session, and we've caught the momentum on the way up. So that's the principle, and that's what I hadn't been applying in some of the other setups when I was doing my paper trading. And the great thing about trading it in real time is that, even though I was recording, which was really super annoying, is that you can actually see that playing out. And when we go back into the day range, you'll be able to see this in much more detail. So the first thing I've done is go and set out the beginning of the session. So I'm just using the exchange hours. I know in ICT's trainings, he's using the New York time frame as part of his whole setup criteria. I haven't done enough back testing yet to know which parts of the session that I should be focusing on. You know, there's obviously a North American, a London, and an Asian session. So I haven't done enough back testing yet to figure out which is the best one. So for the moment, I've just been working off basically the exchange opening and just working on that same premise of that I'm looking at trading from the open to either the high or the low, depending on the direction that I'm looking to take. So today I've got a bearish bias, and what I've done is I've marked the start of the session here, and then I've just gone back and I've marked the previous low and the previous high to kind of set myself a range. So the thing I didn't do in the first video was actually set a midpoint. So I'll just quickly do that now. And so that would be then the midpoint for this session, being between the high and the low from the previous session. So that pretty much sets the parameters for how I'm going to approach the trading session. So if we come in, I'm going to be working on the 1 minute time frame. We can see here that we have the open, and then the market immediately rallies up. This was the first setup that I took just here. So you can see we're just below the high from the previous session. We didn't quite touch it here, but we'd had a number of swing highs here, and then we had this second high here. So my thinking at the time was that this was possibly going to be the high for the session, quite close to the previous high. This fair value gap appeared here. So you can see it's quite small. So you can see the market runs up. So we have this big thrust upward. It actually came all the way down here from 4,100 all the way up to here. So this is the first part of the setup. So you have a 3 candle formation. So this is 1, 2, 3. Just zoom in a bit more. So you can see this up candle followed by a down candle. So this is the thing, this move needs to be quite energetic. It needs to have quite a lot of power behind it. So you can see the initial candle is quite powerful. The second one's not as powerful. Normally this would be more powerful. The third one is quite powerful again. And where the fair value gap is formed is from the low of the first candle and between the high of the third candle. So it's going to be across the body of that middle candle. So you can see it's quite narrow, it's only quite small. And the important part of this thrust is that it breaks the market structure. So you can see this pushes down and it breaks market structure. Market then drops away and then it trades back into the fair value gap here. So that would be our time to get set. So you can see even though we're trading on a 1 minute time frame, there is quite a fair bit of time here to get set to calculate your stop and then go through and set your trade up in your trading platform. So there's 2 ways to do it. You could either do a set or forget method where you come in here and you use your trading view tool. You calculate your stop, and in terms of a take profit, you would just look to the left and you would look for your most recent low, and so that could be down here. Depending on how aggressive you want to be, you can choose to maybe hit the midpoint, or if there's other order blocks sitting down here, or you might if you're really aggressive, be pushing for the other end of the range. But what ICT does in his trades, in his setups, is he's really just looking for that quick win. He wants to take advantage of that big thrust and be in and out. So you can see here, it's going to be a risk reward of about 2.4. So that's not too bad. In most of the back testing that I've done so far, I had a better than 50%, significantly better than 50% win rate. And my risk reward on winning trades was on average about 3. So, that's, pretty good in my books. So in terms of for this trade, actually I'll put this back in so we can see. And so you can see in terms of the setup I was looking for, just drag this across. I was hoping to either hit here or this other low down here from the beginning of the session. And so you can see here, after we get the trade set, takes a bit of time to get going. And unfortunately, eventually we get stopped out. the market just rallies too fast. One trade, 1R loss. So what this says to me is that the initial interpretation I had made that this would have been the top for the day wasn't correct, and that it was still going to be higher. And so what I did is I then went back and I remarked the highs from the previous session just to sort of get a feel for where it could potentially go. And you can see we blasted through the first one and then blasted to the second one. And so then what I noticed is we didn't quite push to the next high, and you can see that immediately as we come through, this has all happened in quite a short time frame, another fair value gap starts to emerge. So I know that now we've pushed through right to the high, almost to the high of the last session, and I've got a bearish bias that really the probability of this setup now should be much higher than this one. And so I'm feeling pretty confident about taking this trade. So you can see we have that big push up. This candle is much more energetic. The third candle, so this is our 1, 2, 3 setup. So 1, 2, 3, and our fair value gap is formed here between the low of the first candle and the high of the third. So again, it's across the body of that second candle, and you can see immediately after the third candle we trade into it. So that's where I get set, and this whole move breaks market structure. The way I read it is that is where it breaks market structure there. We come back in and you can see it immediately just drops away. So the thing that was quite clear, and if you do any of this paper trading first, obviously you want to practice this a lot before you start doing it for real. What you'll notice is if you look at your trading platform, you're on the right side of the trade because you see the volume hit the screen. So with this particular trade, it rallied up once we got set, and you can see it dropped away and it came back here like this. And then you could see in the screen, the market was continuously offered with really heavy volume, and it just drove the market down really quickly. So you can see in this initial thrust, we almost hit our target. So the target was down here. So you can see this has got a risk reward of 6.2. So that's a really obviously healthy trade. Now, what it did first is it came down to this point, rallied back, and you can see this was the first high we were targeting in the initial part of the setup. And you can see the market just kept touching it. It had 3 or 4 touches before it fell away. And so what I went through in the initial video is that, real-time trading, would be completely normal to start to get a bit twitchy and wonder, should I just jump out of this trade? Now, you can see even if we had done that, it's over a, 3R return, 3.3, and if we targeted down here to this, the bottom of this order block here, it would have been over a risk reward of 4. So that's pretty good, but we went for down here for this order block here, and you can see we just had to be patient. Said it kissed this this high number of times before the volume came back, and this all just plays into the methodology behind this system. Is that every time the market just kept pushing back, letting the stops getting set here to create that liquidity before that final sell volume came down, and we got out here. Now, interestingly, if we look at it, the market continued to sell off. So, one of the things that I'd done in some of my paper trading was trading level to level, and you can see that, it hasn't quite made it yet. The bottom of the range is down here, but you can see we got over that halfway point. We've kind of gyrated a little bit there, and the market still feels like it's weakening. And so, having that bullish bias, you could potentially have taken, part profits along the way here and then ridden the rest to sort of see, how much you could extract out of the trade. But this is just, I think, a really good example of, being patient with it. You may not necessarily get the first setup right because you're kind of, testing the market. The thesis is still there. We still have a bearish bias, but we just hadn't quite got the high right. We'd picked the wrong part of that candle in terms of getting set. But you can see here, we made the mistake here, but we just had a 1R stop, and we've come up here and we've managed to bag, almost a 6R return. So we've done 2 trades for the day and picked up 5R, which is a great result. And so one of the things I really like about the fair value gap method that ICT teaches is that, whilst there's some nuance around, picking your levels and your bias for the session, the actual setup itself is quite mechanical. And I can see that, once you get very good at picking these value gaps, the art then, if you like, of picking your entry point and your stop just becomes very second nature, and you get quite quick at it. So in terms of how that works, so we've got our fair value gap here, and we've got our 1, 2, 3 candle set up. Now the way ICT teaches it is your stop should be on that first candle. Now I wouldn't have done that in this example. I would have picked this one, and that's just, I guess, a bit more conservative. But the rules are that you should pick either you can pick either the first candle, the high of the first candle, or the second candle. And then your entry point is anywhere in this fair value gap. Now, obviously, this is on a 1 minute chart. You can trade fair value gaps on any time frame. And on a 1 minute chart, obviously it could move quite quickly. So you could have, the number 1 candle could be a spike up, a big thrust down on the second candle, and then a quick sort of bounce back on the third. And then your next candle may go straight into your fair value gap, and that might be your only chance to get set. Now, the thing that ICT goes through is to not get too worried if you're not super precise with this. So as long as you're, in the ballpark, the market may actually shoot past the fair value gap and not obviously hit your stop where the stop is. And that just means that your entry is just that much sharper, but the rules still stay about where your stop would be. So that just means you've, managed to get yourself a much better entry. Equally, if it's moved too quickly, it's gone into the fair value gap and dropped away a bit, there's nothing wrong with jumping on that trade. It just means that your risk reward isn't going to be as good because you're obviously entering further from the target entry price, or below, in this example, below the target entry price. And so, your risk reward's not going to be quite as good. And there's clearly going to be a point when it's gone way too far away. So, in this example, if you'd missed it, once you get down to around here, you start to question about, do you just need to let it go? And so I think that's an important thing in trading as well. Sometimes you're going to get stopped out. Sometimes you're going to have trades that you miss out on all of the potential return, and that's okay. And then sometimes you're just going to miss them and you have to let them go. So that's just part of trading. I think it's important not to chase it. The setup is important because, we're looking at this methodology has quite a tight stop, and so you're probably going to get stopped out reasonably regularly, but you can see if you get it right, the market's going to run in your favor and you get quite a good return. And so in aggregate, if you're consistent, you can see this is going to be a really good system. And so here's my setup in Ethereum. Now this was a trade that I did with real money. So this is just in a test account that I use. I think I put $30 worth of risk on this particular trade. And you can see that the setup here was I'd marked out my levels. We're at the bottom of the range. I had a bullish bias. I was looking to take on fair value gaps and ride it higher. And this trade was pretty crazy. Part of it was fluke. So you can see here the setup down here. The market's come down, come back up again, shot down. So we can see that's the first candle there. Second candle, third candle, these are all very small because this is on a 1 minute chart. I'm just going to increase the size there a little bit. So you can see the fair value gap there is quite small. So again, we've got the first candle there. So we've got the high of that candle. Second candle, so this is the one that breaks market structure. We can see a broken market structure here. Third candle comes back and our fair value gap is formed. So you can see 2 candles go by and we enter into the trade. Now, when I first set the trade, I actually didn't put a take profit on it. I was interrupted. And so basically my target was looking to the left. I was actually targeting this level here. So, I had in my brain, had my first take profit, or the only take profit there. And we'll just scroll forward. You can see that's not what happened. And so, if I had actually done that, what would that have been? So you can see that would have had a risk reward of 5.4, which would have been fantastic. But what actually happened is, whilst I was in the process of getting this set up, someone came to the door, and so I thought it would only be quick, so I quickly ran to the door, and it wasn't quick. So I ended up being away for almost an hour. And so when I came back, the market was actually around here somewhere. And so I was like, oh, okay, that was much better than what I thought. And I was like, oh, should I just close it out? And I was like, oh, well, it's only a little trade. Let's see if we can really go level to level. And I ended up getting it was up around here somewhere. Yeah, up around here it was somewhere, up around here. So I'll just share with you the actual trade result. So you can see in here at about 30.99 and out at about 31.61. I think that was about right. And so you can see here's the trade here. So buying 20 contracts, so it was only a small trade here. So in at 30.99, out at 31.67. Yeah, there you go, 30.99, 30.67. So a little bit up here. So, that's a risk reward of 15. So that was mostly fluke. I was really only aiming for 5. So you can see that with this kind of setup, it is possible to just go from range to range if you really catch it right. And if you've, got those levels set out correctly, you get your bias right, and, the market just goes completely in your favor. It's quite possible to get that kind of return. The way ICT teaches it, he just talks about looking left and looking to that first level, getting in and getting out. You can see that if I'd actually done that, the trade just pretty much went my whole way right from the beginning. You can see it just went sideways a little bit, and then once it broke this level, it just shot straight up there. And, like I talked about with the Bitcoin paper trade, you can see it when you're in the trade and you're on the right side of it, you can see the volume come into the market. So in this particular trade, I was using BitMEX, and you can see on that Ethereum USD pair, you could just see the bid just getting hit with volume, and then once you're on that trade, it just propels you forward. So you can see that you're getting set, you're taking advantage of the smart money seeking out that liquidity, and you just then ride that wave. And you can see, within, what's this, got set here, 20 minutes, 30, 35 minutes or something like that, and you're in and out of the trade, and that would have been, a risk return of 5 times, and I said, if you are lucky, a little bit silly, you get 15. A real life trade using the fair value gap method on Ethereum. So sometimes it's good to see, how your emotions will work with a really small account, just to test this out for real. Obviously on a 1 minute chart, the market can move quite quickly. And so I found it not actually that bad getting set up. So getting, my risk calculated and my position size and everything calculated and putting it into the trading platform. Even on a 1 minute chart, I didn't find that difficult. So that was positive. I was a bit worried about that when I was looking at this as a potential method. Obviously in a fast market, that would be harder. This wasn't moving, too aggressively. And this was a really great result. I think this is probably unusual. I can imagine that when you get set normally, and this happened when I was doing the paper trade with Bitcoin, your stop's quite tight. So that initial entry is quite tenuous. You feel it feels a bit counterintuitive because the market, in this case, had already, was selling off quite hard down towards this resistance level, and it just feels a little bit wrong trying to buy it. And so I can see that that's something that's going to take a little bit of getting used to, and why it's important to do a lot of, back testing, and before going into trading with a real account, trading with a small account, to, really be confident in the setup. and confident in your ability to apply it, before you're putting real funds behind it, because, you can just imagine getting stopped out quite a lot. And in my experience so far, you will get stopped out, but when the trades are set up correctly and everything aligns, return is quite amazing. So as I said, I've really enjoyed the setup. Looking forward to doing some more work, and looking forward to sharing it on future videos. So there you go. There's 2 paper trades on Bitcoin. One was stopped out for 1R, and the other one got about a 6R return. So that's 2 trades for 5R. That's a pretty good result. And then I also shared an Ethereum trade I did with a test account, albeit a very small one, like $30 worth of risk. And that had a 15 times return, which is crazy. That was more due to my luck and neglect than anything else, where I was really just targeting a 5R return, which again would have been fantastic. So I'm going to keep doing some more work with this fair value gap method, do some more back testing, and I'm happy to share that with people who want to watch this in these videos. So if you're enjoying this video, it'd be great if you could like it. That will help other people to find it. And if you'd like to follow along whilst I'm working through this fair value gap method, feel free to subscribe to my channel. That way you can follow along as well. And if I've drifted away from how you really meant to use fair value gaps, feel free to leave a comment. ICT, if you're watching and I've made any mistakes, please feel free to correct me in the comments. But as I said, I'm really enjoying this method, looking forward to trying it some more, and I'll see you in the next video.